Well, good morning, everybody. Thank you for joining me here online today for GLMI's Expert Webinar Series. The month-end close presented to you by Abby Green, who is the CPA at Jessup Group. Thank you for joining us here today, Abby.
Thank you for having me.
All right, I'm going to go ahead and just take a sideline here. I'm going to let Abby kind of run with the webinar. There's a lot of information to go through, so I want to give her as much time as possible. So, Abby, without further ado, the floor is yours.
Great. And looking forward to share this topic with you this morning on the month-end close. There are a lot of questions about this that, especially in the last 6 months, I would say there's an increased interest in making sure that people have a tight month-end close, and GLMI has a good process for that. So first of all, I did want to talk about what we're going to cover. The first thing we're going to talk about is what the purpose is of the month-end close, what the definition is of that in most accounting circles, a little bit about GLMI's philosophy, about how they've approached the issue of closing month-end, and then we're going to look at the specific steps involved within the system, and then outside of the system, the journal entries that you'll want to post in your general ledger. Finally, reconciling your general ledger after you've completed the journal entries. And then we're going to talk about some common questions that I've received about month-end close. So we'll go ahead and talk about the purpose. First of all, I just want to make sure that we have a common definition. And for our purposes this morning, month-end close process is a discipline of measuring the financial performance once a month. So that is what we're talking about. There are three main purposes in the month-end close. The first is the ability to produce monthly financial statements for stakeholders. And the stakeholders of a home care agency might include an owner who needs to monitor the financial performance of the agency for early identification of problems. Another stakeholder would be a bank who requires financial statements for loan covenants. Trustees or directors of boards for nonprofits that need routine monthly reporting. And another stakeholder would be a parent company that requires consolidated information from one of the subsidiaries. The second purpose of a month-end close is to calculate revenue that meets accounting standards and that reflects the actual activity for the month. For you accountants out there, you know that one of the main accounting standards is that the revenue and expense match for the same period, and this method will give you that information. For some agencies that just post cash disbursements and cash deposits, these are usually revenue for a prior month. So if you're just looking at your revenue based on cash disbursements and cash deposits, you aren't really showing what actually happened in this month. You're showing what happened in a prior month. Also, another common way of recording revenue is to record the bills that were sent to the insurance company in the month. Again, that does not reflect the revenue that was earned in the month. It only reflects your billing activity. So we're really interested in this, for this purpose, to get the revenue that meets accounting standards. And then the third reason to have a month-end close is to have accurate information for benchmarking. Some of the benchmarks that key indicators that use revenue information include a case mix weight, revenue per episode by payer, or revenue per visit by discipline. And for all of these key indicators, if you don't have an accurate revenue calculation, then your key indicator will be wrong. So we need a method to measure revenue, and that's what we're going to do next. GLMI has spent quite a bit of time talking about revenue recognition and has developed a few items of their philosophy on recognition. I thought it would be important to just use that as stepping off point so you understand as the user the background behind this method. The first point is that sound defensible revenue recognition practices are important aspects of good business management. That's just a basic philosophy that is behind the methodology here. Prompt measurement of revenue must be balanced with the need for accurate, detailed patient accounts. And for that one, it's important to understand that we need prompt measurement of revenue, but we don't want to sacrifice our ability to have that detailed patient account history. And sometimes those two goals are at cross purposes. So the philosophy behind this measurement kind of addresses both those needs. And third, the revenue cycle close is a snapshot in time of the data set as it existed when the close was invoked. And as users, you know that this is a pretty quick changing set of data, and it can change from 1 minute to the next. So the philosophy behind this process is to take a snapshot. So here are the steps in the month-end process. First of all, we're going to set a close timeline and publish a yearly calendar. I think that if you publish a calendar and communicate it, then you'll be more successful. One of the most difficult steps that you're going to have when you begin to implement a process is getting all the different departments to come along with you. And in this case, when you think through each of the pieces of information, you have to make sure all of your admissions are entered. You have to make sure your contacts and supplies are all entered. You have to have your adjustments complete. And you have to have all your payments posted that were deposited in the month. Those are usually all different departments of your organization. So by publishing a calendar with deadlines for each of those individuals, you'll make sure the information is ready for you when you need it. The second step in your month-end process is to collect your data and run your reports. These are the specific items that you will need to have in your hands in order to develop the journal entries. And so once each of those departments have all of their information in, then you can collect data. First of all, you're going to need to run the AR reconciliation report. You want to run that twice, once with the PPS percentage checked and once with the PPS percentage not checked. When you're running those AR reconciliation reports, one thing that you want to make sure it gets missed often is that at the bottom right-hand corner of that screen is a place to enter your average length of stay. Make sure that you enter that same number on both reports with and without the PPS percentage mark. That will calculate the unearned revenue properly. The second piece of data you need to get is your total bank deposits for the month for payments on account. You need to have an unbilled visit report, and you want to run that the same day that you run the AR reconciliation report. You want to make sure you know which general ledger accounts you have to use, so you want to have your general ledger chart of accounts available. Most of you probably have that memorized, but just in case, have it handy. And then on the general ledger account, there are two accounts usually that we consider in accounts receivable. One is for GLMI accounts, and that will tie to the PPS AR reconciliation report. And we usually have a second accounts receivable account in our general ledger. That one is to put in our periodic accrual revenue, which we'll talk about a little bit later. It's just easier to reconcile if you have two separate account numbers set up. The next step in the process is to reconcile cash payments in GLMI to your deposit records. It's important that the column on the AR reconciliation report that says payments at the top matches your bank deposits. If it doesn't, then your reconciliation, then your general ledger won't balance to your GLMI report. And just a couple tips on that, you may have deposits in transit, and you also may have remittance advices with credit balances. Both of those will be reconciling items between the GLMI report and your deposit records. Again, if you need help with that, we can follow up and give you some help going through that the first time. Just be aware that if they don't match exactly, that doesn't mean either one of those either the GLMI report or your deposit records are incorrect. It may just mean you have some reconciling items. Once you have all of this data collected, go back to that AR reconciliation screen and make sure the current and previous dates on the screen still match the report, and invoke the close. At that point, you're ready to actually close the period that will lock down those dates. You need to make sure that you do that on the same day that you ran that unbilled visit report, because if you wait until the next day to close, then your unbilled visit report won't be timed right. So that is the completion of the month-end close within GLMI. And now that you've completed that, let's finish the accounting side of things. Step 5 in the month-end close, then, is to post the journal entries. There are 5 basic journal entries that we recommend. The one issue that you may want to just remember up front is that there are probably many forks in the road when we talk about these journal entries, that you may do things just a little bit differently depending on the requirements of your parent company or your owners. So you may have some customization of these journal entries, but they are the basic tools that you're going to use. Journal entry number 1 uses the AR reconciliation percentage report with a PPS percentage on, and records the actual amounts billed and adjusted in the month. This is what GLMI refers to as a hard transaction, and it is recording what actually happened. So you'll use the column 1 on the AR reconciliation report, that is the bills column, and column 2 on the reconciliation report, which is the adjustments column. And you will be using the AR report with PPS percentages on. If you use contractual allowance accounts, you'll want to split journal entry 1. You may want to split it into 2 separate journal entries, one to post the bills and the second one to post adjustments. Most of the time we summarize those 2 into our one journal entry. Journal entry 2 is next. That will record the unbilled portion of the wraps. This step will make the episodic revenue whole for episodes that have only been wrapped. As a result of this journal entry, your revenue will reflect 100% of revenue, whether it's earned or not. And just moving forward, journal entry 3 will reverse out the unearned portion of that. So for journal entry 2, you want to calculate the difference between the ending AR column on the 2 AR reconciliation reports. So it is the difference between the 100% report and the PPS percentage report. That's just one number is all you're looking for, and you're going to post that as a debit into your unearned periodic accrual account. That's that second accounts receivable account that we talked about. Journal entry number 3 will reverse out the unearned portion of the billed and unbilled episodic revenue from journal entry 1 and 2. So between the first 2 journal entries, you have recorded 100% of your episodic revenue and 100% of your billed visit revenue. Journal entry 3 is going to take the unbilled episode revenue column off of the 100% AR reconciliation report and reverse it out. The not earned per diem column is the name at the top of the column on the AR reconciliation report, and it reflects the percentage of the days that fall outside of the period that you're closing through. So if your average days of AR that you entered at the bottom of that report template was, say, 45 days, and you're closing January, if an episode ended on February 15th, the number in the column for journal entry 3 would be 15 days of revenue from January 31st to February 15th. And so we're going to back that out of our revenue because it hasn't been earned yet. Journal entry 4 is to book the unearned visit and episode revenue. Now the first 3 journal entries were from the AR reconciliation report. That's pulling from the accounts receivable history, and those are for transactions that have had an invoice attached to them. But there are some visits and some episodes that haven't had any billing related to them yet. So they're only in the contact file in GLMI. The unbilled visit report gives you an account of that. So if the RAP hasn't been billed yet, it will also show up in this column. There are two columns on the unbilled visit report that you're going to want to pay attention to. The first column is the billable amount column, and that will give you the revenue to post for visit revenue. The second column is the per diem amount column, and that will give you the amount to post for the episodic revenue. So you need both of those, per diem amount for episodic revenue and the billable amount column for the visit revenue. Journal entry 5 is simply reversing out prior month estimates. So since journal entry 2, 3, and 4 are estimates of what is to be billed in future months, that entire amount needs to be reversed every subsequent month so that the dollar amount is re-estimated newly each month. We usually consolidate journal entry 2, 3, and 4 and summarize it into one number and post that journal entry 5. So now you have all of your journal entries posted. Hopefully all your debits and credits are going the right way. That's my famous trick, is to post my journal entries backwards. But if you've done this correctly, then we should be able to go ahead and reconcile the ending AR balances. The report that you will want to look for from GLMI is the AR reconciliation report with the PPS percentages marked yes, and that will tie out to your general ledger accounts receivable account. Then if you summarize journal entries 2, 3, and 4, the total of those 3 journal entries should tie out to your second accounts receivable account, your periodic accrual accounts receivable account. I told Art that we probably need to have a contest and see what general ledger journal entry account names we can come up for that, but I think periodic accrual accounts receivable control account is the closest that I've come. The only way that that second accounts receivable account could be out of balance is if a prior month's journal entry hadn't been reversed right. And on the first account, your general ledger accounts receivable control account, if that does not tie out to the PPS percentage report, you may want to double check your cash payments and each portion of the bill and tie that out to your general ledger detail. You could have gotten something else posted into that account by mistake. Then the third thing that I usually try to reconcile is general ledger net revenue. If you take your prior month's net revenue and summarize journal entries 1 through 5 and add it to that, it should equal your current month's net revenue. Some of the items that may get posted into revenue in addition to these journal entries could be if you have billing that's happening outside of the system. Hopefully if that's happening, you understand why, and that you maybe talk to GLMI about how to get that into the system. The other revenue that sometimes gets posted outside of these 5 journal entries would be a prior period cost settlement, like from Blue Cross. Sometimes those will get put into your revenue account, and that is totally valid. It's appropriate to have those there. I have put together a few of the most common questions that I get when people are starting their month-end process, and I just want to go through those with you so we get some of those out of the way right up front. First of all, one of the questions I get is people sometimes want to record their non-episodic revenue by discipline, and can I use this method to do that? And the answer is not yet. Currently, the GLMI AR reconciliation report, there are ways on the AR reconciliation report to get detail. If you go to the bills detail, the information is there, but it's not summarized so that it's easy to use. What I've asked GLMI to consider whether they can accomplish is to give us a bills column by revenue code summary is an optional supplemental report with that. And then it'd be really easy to do that. For now, you will need to run an activity report by insurance to summarize the revenue by discipline. So you will want to make sure and run that activity report on the same day that you run the unbilled visit report, because it is not date sensitive, so it won't take a snapshot as of the close date the way that the AR reconciliation report does. But if you run that activity report by insurance, you will be able to summarize your revenue by discipline and post it from that. Now, second question, what are some reasons for posting contractual adjustments separately from revenue? For the most part, adjustments should be analyzed from within the billing system because that acts as your subsidiary ledger, and that's where you hold all your detail. They don't really need to affect the general ledger. So we don't normally post contractual adjustments in a separate journal entry. However, there may be some times that you want to include bad debt or free care on your general ledger, especially if you're a nonprofit and you're looking at grant revenue or other sources of support to pay for that free care. Within GLMI, I recommend that you make sure you have contractual adjustment codes set up in your adjustment codes that will help you analyze the type of adjustments you're making. Some of those codes that we like to see include bad debt adjustment code, an adjustment code for adjustments made because a billing period was missed. You had to write a claim off because you just missed a billing window. Of course, you will always have your adjustment codes for contractual rate adjustments if you've entered into a contract at a rate that's lower than your charge. You might have a code for denied visits. If you have insurance carriers denying visits on a regular basis, you might want to set up an extra code for that. We already talked about free care and charity care codes. Some agencies that are in a process improvement process have a separate code set up for visits that are non-billable because the documentation is missing. They have a need to quantify that. So if you think you're missing billing opportunities because you're missing clinical documentation, I would definitely consider setting up a separate adjustment code for that. And another code that is commonly seen is if you're writing off revenue because there was no prior authorization received. So that would depend on how much of your business requires the clinician to get prior authorization to make visits, and if you have a significant amount of revenue that you're losing because that's not working properly. So those are some of the contractual codes that we see. Again, I wouldn't normally expect that level of detail on your general ledger. I would expect to manage it from within the billing system. Question number 3, what if the beginning balance on the AR reconciliation report is different from last month's ending balance? This only would normally happen if you ran the reports but you never hit the close button. Because if you don't actually close the month, then transactions can continue to be processed during that time period. You can tell for sure if you have closed a period if those prior period dates are listed in the template screen at the top of the window. So if there are date ranges listed up there, then that means you did hit the close button. This could also happen if you had tech support reopen a closed period for some reason. That doesn't happen very often, and it shouldn't. But if that did happen, that could cause your beginning balance from this month to be different from last month's ending balance. In that case, you will just want to book the difference in your current month's revenue. And the other reason those are the only 2 reasons that I know that could happen. If it still doesn't match, the first thing I would do is make sure that your dates match so that you're using the exact same bill period end date and close end date that you used the month before. I would rerun the report. I have seen those reports get interrupted, so rerun it at least once and then call support@glmi.com. That's my best advice. That almost never happens, but I have seen it happen a couple times. Question number 4, what are some problems I may encounter when starting the month-end close routine? There are always a few bumps in the road. You find out a lot about your internal processes when you begin to implement this system. So here are a couple of things that you may run across. First, one of the most difficult things is to keep everyone out of the system and from posting transactions while you're running the reports, especially the unbilled visit report. So that's going back to that month-end calendar. If it's very clear on your month-end calendar that there's a half a day once a month that people just stay out of the system and let you run your reports. But if you can't control that, that's one of the problems you're going to run into. Another one is balancing cash to the bank. If that doesn't work out, you want to look at your AR posting date. If you are not using the AR posting date properly, it's going to cause you problems. The AR posting date should match your deposit date. It should be the date the money was received or the date the money was deposited. So check your AR posting date if your cash doesn't balance. And then another problem that I've seen quite often is if you are not keeping your adjustments cleaned up on a routine basis. So if you post payments but you don't go back and write off the unpaid amount, or you know you have some adjustments out there to make and you just don't get to it, you're going to be posting an inaccurate AR balance in your general ledger. So just be aware from your billing department that it becomes more critical to keep your accounts receivable management up to date if you're going to actually be relying on that for your general ledger. So that's the end of our talk today. I hope that's been helpful. You may have more follow-up questions. If so, please feel free to call Great Lakes Microsystems support line, or you can contact me also. Jessup Group does have an internal control audit service, a financial statement audit service, and cost reports, tax planning, and of course this time of year we're all thinking about getting our taxes done. Next month we're going to be talking about cost reports. It's that time of year. Are you ready? Have you already gotten your cost report done? Do you need some help with the basic filing requirements? We're going to go through how to prepare a cost report, the basic steps, so that if you are in a position to do that yourself, you can get started on your own and you can decide if you need some help or not.
Thanks, Abby. I'd like to take a moment to thank our sponsor for this expert webinar on the month-end close process, the GLMI Revenue Cycle Management Team. The RCM team wants you to ask these 3 simple questions. Did you collect all that you could have in 2011? Falling behind in your collections? Tired of spending too much time on billing and collections and not enough time with patients? If you can't answer these questions in a positive way that benefits yourself and your agency, then please give us a call. GLMI's RCM team is here to help. Your first step to answers is only a phone call away. Contact me today to sign up for a free billing and financial audit snapshot. Abby, thank you again for your expert insight into the month-end closing process. I am sure that our listeners out there found this expert webinar as educational as I did. If you have any questions or comments regarding this webinar, please contact either Abby Green or GLMI using the contact information listed on the screen. Thank you everyone for your time today. We look forward to meeting online again next month as we explore cost reports with Abby. Please remember to register for this free expert webinar on the training tab at the GLMI website. And if you feel that someone you know should listen in, please pass along this webinar information. So long and have a great day.